And good afternoon, everyone, and welcome to the Horowitz Company pop-up webinar for September 21st, 2020. So glad you're with me today and every week, of course. So we have an opportunity to answer any of your questions and give you any kind of insights that we can related to finance, the markets, and anything in between. Got to make a quick mention of the fact that this is not a recommendation. And anything we talk about here is not talking about any suggestion for buying or selling any security or accounting advice. Anything we do talk about that even hints at that, please make sure to find the answer from your own financial planner, tax professional, or attorney. So what we do with this discussion is we start going over some of the things that are really, well, I would say shaping markets right now. And each and every week we talk about some of the things that are really important to talk about, some of the things that are really impacting investments in markets and the economy, and we're going to do that. And then we spend some time answering your questions. So make sure that if you have a question, please do me a favor, put it into the Q&A, into the panel there, not into the chat, and we'll do our best to get them in order of when they were asked. Okay, so let's talk about what's going on with markets right now. And I guess we could probably sum it up by saying that markets right now are in correction mode. We saw that major spike recently since that blow-off top where the whale, we talked about this, the whale trader was in there buying options, that was SoftBank, buying options on all the FANG stocks and doing what they could to try to prop up the prices. And as they were buying those options and those upside calls, the other side of the trade, those that were selling those options had to hedge out some of their position. And doing so, what happened was that they were required to basically, well, buy stock. And that forced the pricing of many of the names like the Facebooks and the Apple and the Amazon, the Netflix, the Google, all much higher, pretty much out of nowhere with no news, no fundamental underpinnings that were really changing anything. But we saw that dramatic ramp up in the beginning of this month after several months already of them showing very significant and quite frankly, pretty amazing upward movement on their price. So we had that blow off top where once there was a realization that this was happening, everybody said, wait a second, maybe I don't want to be involved in this. And there was a lot of selling pressure that started. And a lot of that took the markets up all the way from the lows back on March 23rd, started to move up, and they started to fall over, right? They started to roll over after this realization that happened. And of course, we are seeing towards the latter part of this year, where we are now, the potential for reasons for people to say, you know, here we are, maybe I understood, or maybe I didn't understand, or maybe I don't even care to understand why the markets moved higher, but they've moved up significantly with the backdrop of the significant recession that we just had and the potential for a very nice recovery. But you know, there's still a lot of problems ahead of us, a lot of headwinds, we'll call it. And maybe I should take some chips off the table. And as we saw markets come in, and especially due to the fact there was a lot of marginal leverage or borrowing that was utilized to buy these stocks that were moving up so dramatically, there was this reversal that was pretty severe. I mean, we're talking about names like Apple down 20%, the NASDAQ down 12% as an index. You know, the S&P and the Dow off 10, 12% from their highs. And these headwinds that we have right now, inclusive of things like valuations and the question of whether or not valuations are sustainable. And if we're making a case, I think I mentioned this, to try to defend the indefensible with regard to valuations, coming up with reasons why there should be these crazy numbers that we haven't seen probably going back to the year 2000, particularly for tech. Now, back then, it was a much different circumstance. Back then, if you remember, there were all these companies that were going up, you know, in crazy amounts on a daily basis with no earnings and really no prospects. Well, here we had good companies that were moving up, companies that had earnings, that had growth, and that into the foreseeable future, I think we all agree, probably going to do pretty well. And some of them, even with what's going on with the pandemic, the shutdowns, the stay-at-home orders, the work from home, actually benefited from all of this. So pretty much a grouping of winners and losers. But into the end of the year, these headwinds like the election that's happening, the valuations that we talked about, and the latest one, the Supreme Court situation that's going on, where we had the death of Ruth Bader Ginsburg, and now there is an opening in the Supreme Court, and the question of when and if it's going to be a replacement argument that's going to be going on right now in the Senate. So President Trump has said that pretty much immediately by this weekend, Friday or Saturday, he's going to name his pick for the replacement to go on to the Supreme Court. And there's just a lot of argument going on of whether or not it should be done before the next presidential election and what happened the last time in 2016 when pretty much a very similar circumstance happened. And I don't want to get into all the politics involved in it because what it is all politics, right? All of this is all politics. But here's where it impacts the markets. If, in fact, there's going to be this incredible discussion and debate and argument over if, in fact, we should, first of all, do a full Senate hearing to vote for a replacement and to approve an appointment by President Trump, or if we shouldn't, really is not the point. The point is that it's going to take up time. And it's going to take up a lot of time because it's very politically charged in a time when we're getting down to, 40 days or so until the election. And with that, it's going to put other things on hold. And in particular, it's going to put on hold the argument, discussion, and debate about the next fiscal stimulus program. And markets are saying, wait a second, we really had anticipated there would be some kind of program. We thought we were going to have $3 trillion, then we thought we were going to have $1 trillion, then we thought of $1.5 trillion, and we're not exactly sure where it's going to be, but we thought that there would be something. And that something would be to help out the states, and that would be to help out people that are unemployed further than they're being helped at this point. It would help out the airlines, it would help out industry and businesses and all of that. And whether the number is $500 billion or whether it's $1.2 trillion, not the point, but we thought at least we would get a little bit of headway. And if, in fact, we're going to see that there is this incredible debate of whether or not we should, in fact, go through the entire Senate hearing before the election, again, going to take up some space in the discussion and argument over the potential for further fiscal stimulus. So that's a big issue right now, and I think markets are reacting to that, and that was kind of where we came into this morning. Even though there was some resolution, it seemed to be with this whole TikTok fiasco, which I'm not going to talk about because I don't really even understand the whole point here. You know, where our government goes in and says, hey, you know what, you can't be here, but you know what, if you want to be here, we need to take you over. It's very non-capitalistic from the perspective of how governments usually manage companies, where you have a laissez-faire attitude from a government and private enterprise. And while TikTok and ByteDance are not necessarily a private enterprise because they're partially owned or at least involved with the Chinese government, as many companies are that are involved and that are owned in China, the fact still remains that it's a little bit of a weird situation that there was an agreement that Oracle will have a 20% stake or so, 17% or whatever it was. Walmart would have a stake in this, and Oracle was going to oversee it. And then there was going to be no direct oversight or no majority oversight of the core company, but a secondary company that was going to come in. Oracle or the U.S. would have full ownership of, or U.S. company would. Very strange. And then we saw that there was a dissension by President Trump saying, you know what, that's the case. Well, we're not going to do that. It has to be 100% or nothing. So kind of a weird kind of scenario there. But again, newsworthy, attracting the eyeballs and attention of people that are trading for some reason or another. But really, I think the focus right now needs to be on whether or not there's going to be a fiscal stimulus program, because right now we saw the Fed come out last Wednesday, with their discussion about interest rates, saying that, you know what, no longer are we going to be projecting that we're going to have the ZIRP, or the zero interest rate program, zero bound, for a time period that's going to last through 2022. No. Now we're thinking it's going to be 2023. Now that took people off balance for a second there, because there was on one hand a big exclamation of happiness that, wow, we're going to have low rates for a really, really long time, which I think we all know that. With the inflation averaging they put in a couple of weeks back, and the idea that they really are not going to change anything, that they feel they can keep this low for a long period of time, commensurate with getting inflation back up to a level they want it to be and employment back down to a level they want it to be. However, at the same time, you say, well, why are we now projecting 2023? I thought that there was going to be some kind of significant V-shaped recovery for not only the markets, but also the economy. That's why the markets are moving up so nicely, because you figure that, well, the economy is going to heal itself pretty well with all this various stimulus that's involved. And what happened is that people said, wait a second, is the Fed signaling that it's going to take a much longer period of time to get this resolved? That's number one. Number two, when they talked about this weird circumstance where they are really not going to do anything because they believe that just by the sheer desire to do so, seriously, it's this context they were talking, the sheer desire to bring up inflation and down the unemployment rate, and they don't really have to do anything right now in order to do so, because they are projecting and communicating that they are desirous of doing so. That should naturally provide the backdrop of allowing for all this healing to take place. And everybody said, wait a second, wait a minute. That's like sitting in a car with the engine running and trying to mentally will the car to go from 0 to 60 without putting your foot on the pedal. And that makes no sense. And since they didn't add anything to the quantitative easing program, they didn't add anything to what they were doing, markets said, oh, the hell with this. And interestingly enough, we saw that bond prices started moving higher on this. So actually, bond yields, not prices. Bond yields start to move higher on this. So now we have that sitting in the sidelines as well. We have a question about the Fed and their, not their desire, but if they're actually going to go and do something. We have the potential for a fiscal stimulus program being on hold for a little while. And then on top of that, right now, we seem to have a murmur of a concern about a global second wave of the virus. Now, whether or not you believe this or not, and the statistics or not, it's happening. We see a lockdown in Israel for 3 weeks. Whether you want to say that's political or not, okay. But it's happening. We also have we can't say it's I don't believe it's the right reason to do so. It's happening. So we have to kind of go with that. And then we also have in the UK, they're talking about the potential for another lockdown. They already today said they're going to come out with something later today, but also the restaurants and pubs are going to be shut down at 10 o'clock. And this may last at least another 6 months from here. So with that, we saw that leisure and airlines and other pandemic-sensitive names were really getting hit pretty well today. You know, the hotels, the cruise lines, the airlines, where they were beginning to see a nice rotation in. These were the big losers today. And while we saw that the market at one point today was down close to 1,000 points on the Dow, 2.5% on the S&P 500, and about 2% on the NASDAQ. Small caps did finish down towards the lows, down about over 3% for the day. We did see a last hour incredible move where it took the NASDAQ to the positive area, as many of the stocks that lead the markets because of their market, the concentration of them in the market indices, really did very well. We saw the big turnaround on Apple and Amazon today, on Netflix, after they won all those awards last night. So there was this sign of rotation over the last few weeks from growth or tech and biotech into value, which were banks and interest-sensitive vehicles, as well as that post-pandemic trade kind of just stopped in its tracks today entirely. One of the things we also saw today was a big report come out that several major banks in Europe and some in the U.S. were seemingly moving trillions of dollars of suspicious funds that were tagged as suspicious. And that was a concern because now there was this thought that, wait a minute, is there a potential failure to identify money laundering, and are the banks failing in their responsibility, or is this something different? This big report came out, the bank sunk, really bad day, especially for European banks. I'm not really buying this necessarily. I think if the report came out that they did tag and they did flag these accounts as suspicious, that doesn't mean that it is in fact a suspicious trade, nor does it say that it was an illegal trade or a transaction or a transfer. They are required to do so. So maybe what's happened here is a report came out, they were a little bit aggressive, saying, oh, look at all these tagged transactions that were out there. And look how they went through, but that doesn't give us the other side of all this. So over the next few days, we'll see how the banks respond to some of this. And I question whether it would have been that easy for multiple banks to be doing suspicious and, in fact, fraudulent transactions. For what purpose? It's not coming to me. So we've also seen activity on the economic front slowing a bit, but it's still much better than it was clearly in March and April. There's no question about that. But the idea that all of the impact from the pandemic is over is probably a little bit of hopeful thinking. And while a lot of people are blaming the Fed and doing what they can, I don't think the Fed necessarily was the necessary culprit in this sell-off that started pretty much on September 2nd. It wasn't until last week. So we're talking about a full, almost just about 2 weeks later, week and a half later, that the markets really started getting a little bit more, let's just say, squirrely. But that was, again, it started before the Fed's announcement about interest rates and the long-term nature of how long they're going to hold down the interest rates. So I think that there is the potential for this flush out to happen because a lot of people got too excited. I don't see any reason why this is that abnormal, especially because of all the significant upside that we saw during this. But realize that, these are normal types of moves. And, for the most part, our portfolios are set pretty well for these. We saw bonds were bid up pretty well today. We have some inflation protected in our investology as well as our global allocation strategy. So that's all good as the inflation question starts to really come up. We have a low exposure to equities in our managed growth strategy, so that's good. So the bottom line on all this is that we are seeing a lot of, and probably expected, a lot of headlines, a lot of news-driven, a lot of concerning areas about what's happening due to the fact that we have, towards the end of this year, a lot that's going on. A lot that's going on in the U.S. with the election just as one major issue. And we're not going to get into the whole discussion because it's a little unclear right now as to really the impact of either candidate. On one hand, we know that Trump pretty much is very much in favor of markets going higher and low regulations and limited regulations on companies. And Vice President Biden is talking about raising taxes. Well, that's not good either, right? So, how much debt are we going to incur under one where there is no taxes to pay for all the debt that was incurred over the last number of years, inclusive of the incredible amount of debt that we have now on the books due to all the stimulus, the $3.5 trillion or so that was put into play. So there's a lot of things that are happening in terms of the workings of the markets, the expectations of the Fed, the election at the end of the year, or in just a month or so away from here, and whether or not there's some concern if it's going to be a contested election with the problems with voting, with the mail-in ballots and the issues that are going on with that, and the concern with the fact that some people may not even want to go into vote and may have a low voter turnout due to the pandemic. I will tell you that usually what happens, not usually, but I'm thinking that it is possible that we are such a divided political environment right now that some people may just say, the hell with it, I'm going to vote. And we may see actually a pretty good turnout for the election. We'll have to see how that plays out. I don't know. It's going to be interesting to see. Anyway, so what I want you to do is load your questions up in the Q&A panel. We'll do our best to answer those. A couple of things I want to mention here just as a sideline. Number one, the Disciplined Investor podcast. So what's an interesting thing, and I'm pretty happy to let you know, is that this week, or actually last week, the end of last week, Amazon Music through their Prime program has released a brand new platform for podcasts, and we were one of the first in the selection to be included on that platform. So that was pretty cool. So if you have an Amazon Prime account, if you have Amazon Music, either online, you could do it through, when you go to Amazon, or even an app for the Amazon Music app, click on the podcast, and you can listen to the Disciplined Investor podcast right there. That was pretty cool. Other than that, we had a great guest last week. We had Linda Raschke talking about technical analysis. We talked about her 3 keys to success that are pretty interesting, very simple, that really got her to where she is. She's a master at, I guess we call it, not only trading, but investing. She's been featured in Jack Schweiger's books, in Market Wizards. She's been around a long time and has some great insights, and that was this week on the Disciplined Investor podcast. So let me just look over my notes for a second here and see if there's anything that I missed, which I don't think so. So with that, let's get to our questions. Let me load those up. All right. First question comes in from Michael. And hello, Andrew. Hey, Michael, what's going on? Next question, Jojo. What is the limit of non-taxable donations to a family? So I think your question, what you're asking is, how much can I give to a gift to someone without triggering the gift tax rule? I believe it's $15,000 this year. I believe it is. But remember something, you also have a pretty high level of gift that you can give throughout your lifetime. And it's not really necessarily, a lot of people think that if you give too much, let's say I gave $200,000 to somebody in my family, it's outright gave it, or anybody, it's not just a family, it's anybody. If I gave that money out to somebody that, if I'm only allowed to give $15,000, what happens to the other amount that's in excess of the $15,000? There's some kind of gift tax I got to pay, right? Well, not really. The gift tax is really just a notion that you have to say that you have a certain amount over that $15,000 per year per person that you can give away without filing a gift tax return coming under that level. Once you get over that level, you start eating into your lifetime exclusion amount that you can actually give, the lifetime gift that you can give, which is in the millions right now. So if you're thinking about giving more than $15,000 per person, and if you're married, you can give $30,000 per person. And if you're giving it to a married person, you can give actually $15,000 to each person, which is a total of $60,000 to a couple, if you wanted to, per year without triggering the need to do a gift tax return. So with that, if you think about it, if you're going to give a lot more money throughout, in one given year to one particular party, you have to start thinking about filing a gift tax return. It really doesn't go anywhere. It's just something that's going to be utilized once you pass. And you're going to have to figure out, well, how much did I give away? And that was above the $15,000. And how much did I give away through my lifetime that was above that? And then calculate that in relationship to how much you have to give away throughout your lifetime above the gift tax exclusion level. So again, unless you're giving a lot of money away, I really wouldn't worry too much about this. Hopefully that helps. Okay, here comes a long question. Michaels, he says, last week my neighbor told me he had a salesman come over and talked him into rolling his Roth IRA into precious metals, gold and silver, since we'll be going back to the gold standard again, along with the fact, according to the salesman, that President Obama signed an executive order while he was in office allowing the government to seize any IRA or 401k. I told him it sounded like a sales pitch. Have you ever heard of these pitches? I can name the company if you like. You don't have to name the company, but that sounds a little funky. Number one, I am not aware of anything about going back to the gold standard. That sounds bizarre. Now, I don't know if that was explicitly said. That seems like a falsehood. The other thing is that President Obama seizing IRAs and 401ks, if that was a law, why would anybody ever have any money in there if it was available to be seized for just any reason, which is what is obviously being said there. But if in fact that there was an executive order that said that they could seize IRAs or 401ks. Why would he roll his IRA? Why would he have an IRA to begin with? I mean, did he take it out of his Roth IRA? I don't know. That sounds a little funky. And then when you start getting precious metal salesmen that are coming over to the house, you got to kind of wonder about that. I don't know if there's like a free look period, but I would tell your friend to question what's happening with that. It seems a little bit weird to me. Not to mention that, what do you say? But I'm assuming precious, but gold and silver. Yeah, not to mention that silver was down like 8% today and gold was down like 3-4% today. On kind of just a quick sell-off on that after they rose so much over the last year. I would talk to your friend and really try to tell him that he should find out more about that pitch and find out from his own advisor or somebody else that can help him, because it sounds a little bit more like than a sales pitch. It sounds like a little bit of a scam, but I don't know all the details. Next question says, in your recent podcast, you mentioned it may be time to consider rebalancing your portfolio from tech-centric to value stocks. I do like the banks, but with the Fed keeping low rates until 2023, what are the factors that would make banks thrive in a low-rate environment? Totally agree with you, by the way. So what I'm saying to you is, first of all, the rebalance is not an all or one. It's the concept of we may start looking for those avenues and opportunities. And obviously, banks didn't do so well today. But I'm talking about, and I really haven't done this per se. We haven't really fully committed to this, and that's why I used probably the word consider there, is that, you are going to see a higher inflation over time, and I do believe that is happening. I believe we're seeing it already, and I believe that we're seeing it because a couple of things. First of all, obviously, in the CPI and PPI numbers that we're seeing, and the supply chain issues that we're seeing, as well as the excess amount of liquidity that's in the markets that we're seeing, and what we've seen historically over the last number of months with gold and silver and various metals. But at the same time, if that does happen, you would think that the Fed is going to have to, for a little while they'll stay put. But, if the Fed doesn't move interest rates, the markets will. And before today, putting today aside just for a second, and before we saw the news item about the potential for those suspicious bank transfers that were being done and all that, or suspicious transfers that were being flagged that were being done anyway, put that aside for 1 second. But before this, and especially after the Fed talked, we started to see that bonds are starting to sell off and yields are starting to rise a little bit. Nothing major, but starting to rise, and it's been kind of coming up a little bit, even with the Fed supposedly, pushing interest rates down for a very long period of time. Markets will have a say in this also. And before there is actually an increase in rates by the Fed, there will be the market sniffing out these areas that will do well. If the market, or I should say the economy, recovers and we do get back to a sense of normalcy, even though there's a lot of weirdness out there with Israel locking down Britain and Europe having a second wave and concerns about things around the world, there is the opportunity for banks to be, they're cash cows essentially. Their net interest margins are definitely squeezed in this current environment, but I'm saying that you need to keep an awareness on that and start maybe to dollar cost average into not only banks, but financials and the value side of the equation. That, in fact, this month, I think month to date, the value side is down like 2.5 or 3% with today, and the growth side is down like 9 or 9.5%. So we're starting to definitely see not just a rotation, but also a preference from the growth which people have been investing in, without any question about and without any regard to the underlying fundamentals, saying that maybe we should look for things that have a better value proposition right now. So answering your question, what factors are there that make banks thrive in a low interest rate environment? The only thing I can tell you is the potential for some technology that will come in there, but really the net interest margins are the biggest issue. The problem you also have, though, is if we continue to have an elongated, I'll call it recessionary, but more of a slow growth and problematic area with regard to consumers not getting fiscal stimulus, et cetera, that's a problem also. You'll have delinquencies, you'll have defaults, you'll have commercial properties a problem. So you got to kind of steer clear to what area you want to be in that. But I think value is just something to keep on your radar screen if we get past some of this, because I think there'll be a big ramp. Again, once we get past this, we have to keep it's not today necessarily. Tim, and by the way, if you have any questions, no question is too small. No question is insignificant. No question will be laughed at unless it's a joke and you want us to laugh at it. But put your questions in. This is the time that you have right now to ask anything you want on any subject that's been itching you maybe for years. Go to the Q&A panel and put your question in there. All right, Tim asks, Andrew, thanks for your continuing efforts to help your listeners. Has there been a few times you can identify where value outperformed growth when there was a lot of liquidity, large Fed spending, and low interest rates for at least greater than 2 quarters? Well, recently there hasn't been. The last number of years it's been a growth game. But you go back to 98, 97, 98, 99, and there's been several times that value will outperform growth. But right now, when we have the game being, I'm not going to say rigged, but played by the Fed, and if you look at interest rates over the last 10 years since the financial crisis, clearly there's been a substantial amount of pressure on interest rates, which again, as I talked about, hurt the net interest margins, the margins of the banks. So we don't have this curve on the yield curve that is really cooperative to banks right now, but there's been plenty of times historically where values outperformed growth. Not over the last year or so, I'll tell you that, not really 2 years. But before that, if you go back to several quarters post the major times of 2009, when banks kind of shot up because they were getting those, obviously a lot of shot of liquidity. But you go back in time, value had until probably the last 5 years had a long-term history of outperforming growth. So you can put that on a chart and you can kind of put that and look at the comparisons on a percent change chart and look at different times and you can see that. But that's a good question. Quan asks, hey, Andrew, wondering if we know whether or not those whales made a prop for the tech options gamma trades. If so, would we not be able to do it again and again? It looked to me as they're unwinding those trades, and if it was any unwind after the realization that the realization of when they put it on, they had to have lost money. They had to lost a ton of money. I mean, they lost money on the underlying, and because they had calls that they bought, not covered calls, not shorted the option, but they had calls that were just geared to upside. It flopped right afterwards. So maybe they put some on a few days before that they made some money on, but if they held it any time after when we found out about it, they lost a bundle on it. I'm not sure, but I don't know why I'm thinking that there was. My recollection is there was something that showed that they did lose money, and that's why they're unwinding it. And there was an announcement by SoftBank that they are going to reconsider their option trading strategy, which just leads you to believe that they lost money on it, right? Just leads you to believe that. Now, will they try to do it again? Yeah, possibly. Will we know about it? Maybe they'll try to hide it a little bit better. I mean, these were $4 billion worth of options that were traded. Hard to hide that. Very difficult. Craig says, hey, love your podcast. Thanks, Craig. Early in the year, Whitney Tilson said Tesla did not make any money per car. Do they really make lots of money or not? Thanks, Craig. So over the past, Tesla's made a very significant amount of money on tax credits per car. And that went away, and that was something where they made money. If you look at the last earnings report, and remember something, Tesla doesn't have, they have overhead, but they don't have overhead like many of the other car manufacturers out there. First of all, you ever see a Tesla commercial? There's no Tesla commercials, right? Have you ever been to a Tesla dealership where they have a massive floor planning going on with, thousands of cars on the lot? No, there's like 4 cars. Have you ever been to a major Tesla repair shop? There's not a lot of them. There's not a lot of overhead. And more importantly, the big differential, by the way, between Tesla and other car manufacturers is that other car manufacturers have a significant amount of pension liabilities, humongous. As a matter of fact, like GM, I believe, has more money they pay out to pension, to pay for pension payments to former employees that are retired than they do to employees that are currently working. Now put that in the scenario, and then if you think about that for a second, you'll understand why there's such difficulty making money for Ford and GM and some of the old line car makers with the unions and all that goes on. Whereas Tesla, while they make some money per car, a lot of that was, in the last few quarters, was all based on their net profits were based on the sale of tax credits to other companies that needed them because they were carbon emitters. They had to, instead of getting taxed, they would buy the tax credits from Tesla, which had all tax credits per car, whereas a Ford had a lot of diesel with a lot of standard, regular, old-fashioned gas engines. So they made, I think, a profit of $330 million last quarter, net, and I think most of that, if not all of that, was due to the sale of these carbon tax emission credits. So my understanding is that they are not really making money per car, but that may change as they ramp up production and they can try to, squeeze a little bit more out of each car. But it's a pretty thin margin, just like every other car manufacturer. They just had other ways to make money. All right, do we have any other questions? Kind of quiet today. We had like 10 questions. Anybody else before we close off for the day? A lot of people here. It's Monday. I know it's tough. All right, if there's no other questions, we're going to end it right here. Make sure to listen to DH Unplugged tomorrow night at 9 o'clock live. John C. Dvorak, myself. We have a lot of fun talking about a lot of... It's a pretty crazy show. Other than that, we'll be back next Monday as well. And load up your questions. Let me know. Check out... by the way, if you haven't seen the TDI Managed Growth Strategy, the new virtual tour, pretty cool. So you can see that over on thedisciplinedinvestor.com. Check that out. All right, we're going to end it here. I will see you again next week. Thanks.